Morgan Stanley capped off a mixed quarter for the big banks reporting earnings this week. Goldman Sachs, JP Morgan, and Citigroup all reporting a lower fourth quarter profits, ending a streak of big gains. But Morgan Stanley, Bank of America, and Wells Fargo did report an increase in profits. Higher operating expenses, however, having the most impact on earnings in the banks, with Wall Street deals and rising inflation and a tight labor market among the issues. Joining me right now is the founder and editor of the Bear Traps Report, Larry McDonald, who has his finger on the pulse of markets. Larry, it's great to see you this morning. Thanks so much for being here. First, give us your assessment of earnings so far. What strikes you most in terms of the bank numbers that you saw?
Well, the bank earnings, it's a battle between new deals in investment banking and trading flow. And trading flow has been off dramatically, whereas investment banking revenue has been very hot. But net, the banks are really facing headwinds from things like financial technologies coming at companies like JP Morgan. So the old traditional banks are facing really a disruption period here.
What are you hearing from your 600 buy-side institutional investors that you're talking with so much, Larry? You've been warning about the cobra effect, where stimulus designed to save the economy instead causes hyperinflationary and an economic collapse. We're looking at inflation every day. We're at 40-year highs, with prices climbing 7% in December on the CPI year over year. What's your take on inflation and how that's impacting things? Give us the example of this cobra effect.
Well, what's remarkable, Maria, is that in the history of the Republic of the United States, 28% of all dollars ever created were done so in 2020 and 21. 28% of all dollars ever created. So what happens is you have a crisis like either Lehman or COVID, and then there's a government response. And now we're having a cobra effect where the unintended consequences of government policy are creating a massive shift. I mean, this is such an incredible period to be alive. We're heading back toward the 1970s, 1980s, where you really wanted to be long hard assets and value stocks, whereas the previous decade that we just lived through was a deflationary period where financial assets did really well. So stocks, growth stocks and bonds. Now we're coming in a period where hard assets are going to really dramatically outperform.
Yeah, I was looking at the list on your Bear Traps report earlier. You've got copper miners up 20%, Exxon up 19%. Go to the bottom of the list, biotech stocks down 18%, Netflix down 14%. So that value versus growth has been completely reversed in the last few months or so. I want to get your take on rate hikes. What do you think? How many rate hikes do you expect the Fed to put in place this year?
Well, the Fed has really done a job here on the average investor, because they've been selling us hard that inflation was transitory. So what happened was you had an incredible buildup, as you just said, in growth stocks and deflation plays. Now the Fed's coming clean, admitting that inflation is much more sustainable on a higher trajectory. And so they're out there trying to claim that they're going to do 4 hikes this year and maybe even more next year. But the fiscal drag right now is 9% of GDP because of the fall off in spending. 9%. That's 3 times the largest one in the history of the country. So you've got a colossal fiscal drag in the face of rate hikes, and the market is starting to react to that. That's why I think growth stocks are starting to come down as hard as they are.
Well, look. Yeah, I mean, the issue is markets will react when we see these multiple rate hikes coming. Yesterday, we spoke with Larry Lindsay, the CEO of the Lindsay Group, former National Economic Council director, and he walked us through what he's expecting from the Fed. And he says once the markets figure out what's going on, the Fed is going to be forced to take to the sidelines. Here's Larry Lindsay. Listen to this.
Now I think the Fed is embarrassed and feels like it has to catch up. Still, I don't think you're going to see rate increases at that imprudent a level, you're kind of walking in the dark still, and this is one of the problems with waiting too long. I think the Fed is going to probably increase rates 4 times this year, starting in March. It'll be interesting to see if they start their quantitative tightening, where they actually start to sell off their assets. But the market is going to react strongly at some point.
So what about that? They think he thinks the Fed's going to put rate hikes in place. The market sells off, and then the Fed takes to the sidelines, and it will be forced to take a pause. What do you think?
Yes, I mean, that's been a consistent pattern. 2015, 2018, the Fed overpromises, and then unfortunately, sell-side banks are really pawns of the Fed. So the Fed leaks their guidance to the sell side, to the banks. The banks go out and tell investors, oh, 4 hikes this year, 3 hikes next year. And they're just like pawns. And at the end of the day, the Fed's overpromising on how much accommodation they can actually pull back. And then you have a big reaction in the market. I think the trade for the year, the gold miners have been beaten up. And if you look back, and the silver miners, if you look back historically, when the Fed backs away from an accommodation path, that's when precious metals dramatically outperform. So last year you had industrial metals dramatically outperform. This year you're going to have precious metals outperform. And silver, for example, electric vehicles, you're looking at companies like Tesla are now contracting out actually purchases of long-term contracts for metals in the electric vehicle space, solar. So you're going to have a major deficit of these metals, and that's where I see the best upside for 2022.
So sell stocks, buy hard assets, Larry, still in 2022. Even after this big sell-off we've seen, it's not done yet, is what you're saying.
Well, yeah, or value stocks. So Intel, your AT&T is outperforming the NASDAQ by almost 30% since December. I mean, this is incredible.
Wow.
Intel is outperforming NVIDIA by like 35%. So value stocks, what I mean by hard assets are, copper names, gold names, silver names, platinum. Platinum names have been beaten up. And platinum is a huge component of hydrogen fuel cells in the future. So you get some real sexy metals here, Maria.
I love the sexy metal story, Larry. I'm with Mark Tepper today. Go ahead, Mark, jump in.
Hey, Larry. So my question for you is, if you're let's say, a pre-retiree or a retiree, and you've got your money invested in a portfolio, and all of a sudden next year the market's down 20%, you don't want to have everything in stocks, because how are you supposed to pull your income out? By selling stocks when they're down 20%. It also sounds like you're not a big proponent of bonds either, which I agree with you. I think bonds have been a tailwind to performance over the last 30, 40 years, and they're going to be a headwind going forward. So for the retiree investor, how do they hedge market risk? Is gold the answer?
See, that's a great dynamic problem, because when Lehman fell, stocks lost about $7.5 trillion. The good news is bonds made up about $3 trillion. So that risk parity dynamic worked well in after the Lehman collapse. So you had a $7 trillion, $7.5 trillion loss on the stock side. The bond side gave you back $3 trillion. Now with rates so low for so long, and they've suppressed interest rates, the component there naturally isn't there, that protection. So it's really the new asset allocation is going to be much more stocks, bonds, and then income-producing stocks and value stocks. That's hard assets. That's the portfolio of this year, probably for the next 3-4 years.
Larry, what a great conversation this is. Thank you so much. We're going to continue reading the Bear Traps report and talking with you along the way. Good to see you this morning, Larry. Thank you.
Thanks, Maria.